Hello, this is Robert Dumas from TaxConnex. You're watching the third step in our 5-step series on how to get your company sales tax compliant. Before we go into the details of this third step, which is determining your prior period tax liability, I want to make 3 important points. First, determine any prior period exposure prior to making decisions about how you're going to manage your compliance prospectively. If you have a prior period liability, you want to mitigate the exposure. And to do that, you need to know the exact amount before making any decisions about registering your company or doing VDAs, etc. So be sure you do this step before making any of your long-term strategic decisions. Second, bucket your tax collected separately from your uncollected taxes. You should know any of the taxes that you collected from your customer. These must be remitted. You have very few options in mitigating exposure related to collected taxes. Your uncollected taxes, however, give you some more flexibility. So be sure you distinguish between collected and uncollected taxes as you're calculating your prior period liability. The third thing to remember is I want you to be conservative in your estimate. In other words, I want you to come up with a worst case scenario and then you can tweak it. But I think it's very important to start out conservatively rather than aggressively in determining the potential exposure. All right, now let's go into how you actually calculate your exposure. As you recall, step 1 of our 5-step process is determining the states in which you have nexus. So the first thing you need to do is isolate your revenue to those states where you know you have a sales tax collection responsibility due to your nexus. So segregate your revenues by state, by nexus states and non-nexus states. In your nexus states where you have revenue, then distinguish your revenue between service revenue and property revenue. Generally, all sales of tangible personal property or property-related revenue is going to be subject to sales tax. So separate that from your service revenue. In certain cases, however, and certain industries, your service revenue may also be subject to tax, so you need to know that as well. But segregate your revenue between taxable and non-taxable. I recommend going back and determining your exposure for 7 to 10 years. Again, we're trying to be conservative. So determine your revenue by nexus states going back as far as 10 years, at least 7 as far back as 10. Determine a composite sales tax rate to apply to your taxable revenue. You're going to get your composite rate by state if you want to be that specific, or you could do a general nationwide rate of 7.25%. Again, it's an estimate at this point. 7.25 nationwide is going to be reasonable, but you could also do it on a state-by-state basis if you have that kind of detail available to you. Multiply that composite tax rate by your revenue by state, and you're going to have your potential sales tax exposure. All right, after you get this number, you can then tweak it and fine-tune it. So you want to review your estimate and make any adjustments. Some of the adjustments you're going to want to make are related to materiality. This is where you can apply a materiality standard to your calculation. And that materiality standard is really going to be based on your business's appetite for risk, cost, benefit. For example, if it's $100 of exposure, you may just want to do no further analysis for that particular state because $100 obviously is not material. Then drill down to your revenue types. As I mentioned, we bucketed by service and property related revenues. If your number is significant, you're going to want to drill down into your revenue to determine if you can find or isolate more non-taxable revenue. Then drill down to your customers, because some of that revenue, some of that taxable revenue may really be exempt revenue because your customer is exempt, they're a nonprofit, or they're purchasing from you for resale. So that's another option. If you have a large part of your revenue with 2 or 3 customers, go back to those customers and ask them if they by any chance self-assessed use tax on that revenue. Because if they've paid use tax, you don't need to pay sales tax again. You're just going to have documentation of their use tax payments. Finally, update your rates. As you drill down by state, determine if you have any revenue in a particular locality that may have a higher or lower tax rate. So drill down on your effective rate as well. Finally, determine if any of the sales tax that you've calculated has in part been paid to your vendors. When you're purchasing materials or supplies or inventory for resale, you may inadvertently be paying sales tax to your vendor, and you want to determine if you could potentially take any credits related to sales tax paid to vendors. Again, I want to reiterate, any sales tax you collected, you have to remit. There's not a materiality you should be applying to that calculation. So if you've calculated sales tax and collected it, bucket that separately from your uncollected sales tax. All right, in step 4 of our 5-step process, we're going to tell you your options for mitigating the exposure you just calculated.